Good morning. The double hit. Why shutdowns hurt both CRE values and lending liquidity. When the government or financial markets experience shutdowns, commercial real estate or CRE takes a double hit. Investors and business owners feel it first through falling property values, and then again when lending liquidity dries up. And this 1-2 punch can stall transactions, derail development projects, and tighten credit conditions just when the economy needs confidence the most. And I hope we find resolution soon. The first blow: uncertainty drags down property values, and shutdowns create uncertainty. Whether it's a federal budget impasse, a government data freeze, or a temporary halt to approvals, investors hesitate. And without clear visibility into future demand or economic stability, cap rates could rise while property values could decline. So, for example, during the 2019 US government shutdown, appraisals and underwriting timelines ballooned as economic data releases paused. So CRE buyers adjusted their pricing models downward to account for that risk, especially in office and retail sectors, already facing structural headwinds. Now, the second blow is that lending liquidity tightens. Now, if values are dropping, financing simultaneously becomes harder to obtain. Banks and private lenders react defensively during uncertainty, tightening their loan to value ratios, or adding covenants to loan approvals or commitments, or delaying funding decisions. And in particular, SBA and USDA programs stall entirely when federal employees are furloughed. So think SBA 504 and USDA. For investors relying on acquisition, construction, or refinance capital, this can create gridlock. And even cash-rich borrowers face slower closings and higher spreads as lenders take a wait-and-see approach. Number three, there's ripple effects on the market. So shutdowns impact everybody: sellers, buyers, and tenants alike. Investors lose confidence and delay acquisitions, and developers could face delays in permitting, inspections, or especially when they have HUD or SBA-backed loan approvals, which require federal employees to review. Lenders reprice risk, often pulling back from deals mid-underwriting. And this creates a bad feedback loop. As lending liquidity evaporates, transaction volume drops, further depressing comparable values and widening the bid-ask gap between buyers and sellers. So let's put an end to this problem. Number four, how savvy CRE players adapt. So smart investors and brokers can stay proactive during these periods by: one, diversifying lender relationships across banks and non-bank channels. Favoring non-bank with a shutdown is the key takeaway. We can use bridge or DSCR loans to maintain deal momentum while the others are stalled. We can keep cash reserves ready for opportunistic acquisitions when prices dip. And at Medallion Funds, we help clients navigate market volatility with creative financing and data-driven valuation strategies. Understanding both the lending environment and the market psychology behind it is really what separates winners from the sidelines. So here's the final thought for the day. A shutdown isn't just a pause in government operations, it's a pause in market confidence. The key to surviving the double hit is remaining flexible and agile, strategic lender relationships, and disciplined underwriting. And that's it for the day. Have a good one.